Okay, so hey everyone, this is Finance Meets Real Estate. So we meet here every Tuesday normally and Thursday today with weekly webinars. We have incredible guests every week, like our guest here today. And we are also a YouTube channel. So one moment, I just want to make sure I think I'm hearing a bit of background noise.
Yeah, a couple of people have not muted themselves.
Right. Okay. Yeah. Sorry, Greg. I just muted everyone. Okay. Yes. So we are a weekly series. We're also a YouTube channel. So make sure to check out our YouTube channel, Finance Meets Real Estate, on YouTube. So okay. So today we have Greg Dickerson here today. So he's an incredible guest. He's going to talk about the secrets of billion-dollar operators. So he's the founder and CEO of Dickerson International, and he would discuss. Today's topic, and he's going to go over how he went from 0 to 1 billion in assets under management from scratch, essentially starting from scratch. So he is a serial entrepreneur, real estate developer, coach, and mentor. He has both developed and sold over $250 million in real estate, built and renovated hundreds of custom homes and commercial buildings, and developed residential and mixed-use subdivisions and started 12 different companies from the ground up. That's an incredible resume there. And so he currently coaches and mentors some of the top entrepreneurs, real estate investors, and real estate developers around the world. And his clients have over $2 billion in assets under management and deals in process. So he's an expert on few different topics, so entrepreneurship, leadership, and real estate, and he's regularly interviewed on some of the top real estate investing and business podcasts today. So prior to that, he was in the Navy as well, and he has been a leader in the community, supporting and serving different boards of churches, ministries, and nonprofit organizations. Okay, so with that, I think it's a great profile there. I hope the introduction was okay, and I'm going to pass it on to Greg. And so we're going to do an open format Q&A. If you guys have any questions, feel free to speak up or put them on the chat, and I will relate at the end.
Yeah, thanks for having me. I apologize to everybody about the scheduling, but I got hit with COVID Monday, and we were supposed to do this Tuesday, I think, and my voice was just not up to it. And as you can hear right now, it still has not fully recovered, but I'm on the 4 days in, so I think I'm almost over it. But
thanks, Greg, for joining us. Now, I know it's COVID sucks, so really appreciate it.
Yeah, this one, aches and fever and chills, but then it hit me in the chest, and just it's hard to talk and go without coughing and hacking for a few minutes, but feeling pretty good right now, so I think we can get through it. But yeah, long story short, serial entrepreneur, real estate investor, and developer. So bought, developed, and sold over 250 million in real estate using my own funds, and then hundreds of millions with partners and investors, and then started, scaled, and exited 12 different companies, and for I don't know 400 or 500 million in value there, and generally reinvest all the profits in real estate. So that's me. Long story short, I joined the Navy right out of high school. I didn't go to college, so I learned everything the hard way. Very self-educated, even though I'm not formally educated. I've educated myself, and I continue to every day. And and I coach and mentor people all around the world doing all kinds of different things. Real estate operators, business operators, people that have exited companies with significant sums of money, helping them manage and navigate the global macroeconomic climate. So currently, I do fewer bigger deals in terms of real estate, and then I invest in markets and crypto. Got into crypto a few years ago. So doing a little bit of everything, and just kind of enjoying life.
Right, and you actually on the crypto part, you actually speak about like Bitcoin and other cryptocurrency on your YouTube channel as well. And I say you guys make sure to check Greg's YouTube channel, which is I think has great value and content there. And
yeah.
Right. Yeah. So that's impressive. So how did you start into real estate first, I guess? Did you go to bigger deals right away, or did you kind of first do like single family and other investing? Like, what was your path that way, I guess?
Yeah, I started small. I started as a little remodeling handyman contractor. And, so my first deal that I got into was a lot flip that a friend of mine was a realtor. And, I had made some money and was, somewhat successful. He said, look, we've got this lot, we can buy it. My dad has a client that'll buy it from us, and you put up the money, I'll do everything else. So we did that. And it was like $100,000 lot purchase or something, flipped it, made 15 grand a piece. And I was like, wow, this is great in like 30 days, And then as a builder, started as a little remodeling handyman contractor, started that company from scratch, just me, my own truck, my tools, doing whatever I could do myself, built that into a $30 million building company in 7 years, sold it, and used all the money to reinvest in other real estate deals, started 12 other companies during that time period, built them all up, sold them off. And I started working for other investors and other developers, and I started going from remodeling. So I had investors that were coming down to the area I was in. They were buying these big, beach houses on the Outer Banks of North Carolina, multi-million-dollar beach houses. They'd hire me to do an addition, put a pool in, do whatever. And then they would either rent them or sell them. And I started watching what they were doing. And I said, hey, I want to get into some of these deals. And they said, well, let's see how you do. And maybe we'll, teach you how to do this. And then they started building spec houses, and I learned how to build spec houses. So that's kind of how I got started. And then as I scaled, that, I started getting into land development. What I realized was the money was in the dirt, not the vertical. The vertical was to extract the value out of the dirt. So I started going after land deals and started doing more land development, mixed use subdivisions, commercial buildings, bigger deals. And I kind of grew my network, and the people that I was working for were all, bigger developers that were doing hundreds of millions to billions of dollars, a year in development deals. Some of them were worth 400 or 500 million. A couple of them were billionaires, two of the largest developers in our region. And my region is from North Carolina to DC. So I was doing a lot of work for big developers coming out of DC, Richmond, the Hampton Roads area, that were buying beach property, down on the Outer Banks. So that's kind of how I learned the trade. And that's where I kind of first started learning the secrets of, the $1 billion deals, the $1 billion portfolios. Is you don't know what you don't know. And, you're only limited by what you know, when you know it, and the vehicle that you apply it to. And that's really the difference between anybody doing a single family deal or doing, hundreds of millions of dollars in transactions to $1 billion portfolios. It's all a matter of what you know, what you apply it to, and when.
Mm-hmm. And so do you want to dig into that a little more? And even, because to me, like, even the way you started with like having your own contractor company, but actually selling it for 30 million valuation. So that in itself is like, it's a big accomplishment for many contractors, considering like even valuation multiples in what is like kind of like construction company space. So what was your strategy to be able to do that and sort of like build a business that is, it's not tied to yourself, if you will, that is something that a new buyer can come in and pay a, top dollar for that.
So, I was very fortunate, like I said, very self-educated. And I learned early on through, developing myself, reading books. I read Rich Dad, Poor Dad. That was one of the first books I read. Did retail in the Navy. So I got some little bit of business training in the Navy. When I got out, I worked in the restaurant industry. So I got some good leadership management training in the restaurant industry. And then, one of the first investing books I read, whatever you want to call it, investing, was Rich Dad, Poor Dad. And what I got out of that was I wanted to be Rich Dad. So I didn't want to be Robert Kiyosaki. I didn't get real estate out of that book like a lot of people do. I want to be Rich Dad. He was the guy that was, had all the businesses, was doing all the deals, but he didn't run anything. Everything was coming to him. The deals were coming to him. The people were coming to him. The opportunities were coming to him. He oversaw a portfolio of things, but he did it all through other people. And that's where the light bulb went off to me. And that's what I started doing. So my first company, I'd never built a house before I started building $1 million beach homes. So what I did was, number one, I picked a name that I knew I could sell. So whenever you start any business or do any venture, you always have an exit strategy. Everybody exits, everybody liquidates. It's just a matter of when and how. So when you start with that end in mind, I know I'm going to sell, I know I'm going to liquidate, I know I'm going to exit. Then you want to build a brand that's not tied to you personally in that regard, versus like an influencer brand or something. But, from a company standpoint, you want to build a brand that can stand alone without you and your name. And you want to put people, processes, systems in place so that business runs better without you than it does when you're there. And that's the true mark of a great leader, how well your organization runs when you're not around. It should run better when you're gone. If you've got the right people, the right systems, the right processes. And my philosophy in business was always people, operations, profit. Focus on the people. They will take care of the operations. The profit will be there. So that's kind of how I did that. So when I first started building, like I said, I didn't know how to do it. I'd never built houses. I went and hired the best people I could find and brought them in to run it. Case in, point that I always use is, Tampa Bay Buccaneers. They wanted to win a Super Bowl, right? What do? They go get the best quarterback in the world. They bring him in. and they put him at quarterback. They didn't bring him in and put him a wide receiver. They didn't bring him in and put him on defense. They said, we want to win Super Bowls. Let's go get the guy that knows how to throw touchdowns that will get us to the Super Bowl. They bring him in and they let him do his job. So that's how I built my companies, was through with and through other people like that. Let them do it. And every business I built, the end goal was to exit. And, multiples were different back then than they are now. I think that was a 3 or 4x multiple back then, for a building company, end of the year when liquidity was flowing, you could have exited one for probably 10 or 12, but now you're back down to 3 or 4 again. So, that's kind of how that went down.
Mm-hmm. So you wanted to be like to reach that in the book and kind of be like private businesses, kind of build private businesses that work on their own, that are structured not just on their own, but that would work even better when you're not there, right? And so forth, and like with exit strategy. And so that was really, it's really kind of a private businesses, but perhaps private equity kind of mindset where.
Yeah, it was all private equity, and, build great businesses that generate cash flow to invest in other assets. I mean, that was really my theory, my thesis, my system. And I did that over the years. The problem was all I knew was what I knew. So I didn't know back then how much I could have really done, and how much further I could have really gone, because I was just starting from scratch. I didn't know anything. I had no mentors, YouTube wasn't a thing, you just really couldn't look this stuff up. And there was nowhere to get this kind of information from people like me. So, I did what I knew how to do, and it was small companies, 30 million here, 10 million there, 5 million here, stuff like that. Those are small in the whole scheme of things when you're in the world of unicorns that we are today, where everybody's exiting for $1 billion. But again, that was a, pre 2022 liquidity drain process, so different environment now. But, I just didn't know those things. And, knowing what I know now, going back then, I would have been more on the hunt for a unicorn than I would, an electrical company or a, plumbing company or a building company.
Mm-hmm. So what was your lesson, Camp? What was your insight into that? Like, what would you do now, basically, let's say, in terms of to try to scale a larger business or business that has, what do they call it, kind of like a bigger market where like the total, what do they call it, even like in business, doing like the total market is of a certain size and you can tap into it and so forth. And what would be what that you would do now that you didn't do back then?
So just go way bigger. I just didn't know back then how big you could really go and how much easier it is when you're going bigger, because there's a lot of, from an equity standpoint, private equity, there's a lot of funds out there that like to write big checks, and when you say go big, that's and this is the secret to the $1 billion operators. So when I say go big, it's more than just go do big deals. You want to solve big problems, and the most successful companies out there are solving big problems at scale. So, I knew where there's a problem, there's an opportunity. And I started out my career of solving problems. And that's how I started my original company. I had a problem, and there was a problem in the market I was solving, the need for good contractors that would call you back and show up, but in this day and age, if you think big and you think how big of a problem can I solve, one of the biggest problems out there is there's a lot of capital still on the sidelines that needs good places to go. It needs good companies. It needs good solid operators in real estate deals. It needs, good sponsors for different ventures to send big checks to. So if you're somebody that I can write a, 50 or 100 million or $300 million check to, that's solving a big problem for me, because I got all this capital I got to push out there as an equity fund, right? So that's the big thing that a lot of people don't realize. A lot of people think, wow, I got to raise 100 million. How am I going to raise 100 million bucks? There's equity funds out there that like to write $100 million checks, and it's easy for them, makes it easier. And the biggest case in point in that is WeWork, right? I don't know if y'all know the WeWork story, but he solved a problem by giving big chunks of capital a place to go, and he put a good story behind it, and he's doing it again. And he just raised a $300 million raise after, one of the biggest blow-ups on Wall Street. But the reason is he's providing a place for that money to go. That equity fund has a lot of money they need to write. So whether it's real estate, whether it's a company, no matter what it is, if you're a good operator, you know what you're doing, you're a solid, sophisticated operator, and you've got big opportunities for capital to flow into, you're solving a huge problem out there right now.
Yeah. That's a great insight. And so essentially going bigger makes it it's way easier to sort of streamline the process by getting, large capital checks and so forth. Since that's really the need that is out there. It's to distribute big capital. There's a need to distribute like small amounts of money within like private equity firms and so forth. And so so essentially it gets easier to think bigger and do bigger things. And so that's a great insight there. And so what about like investing in like real estate or cryptocurrencies and other things that you did once you built, let's like you exited your construction company and you kind of like you started getting into other businesses as well, but you presumably needed to invest your capital somewhere. So did you invest it in passively in other private companies? Did you invest it in the real estate exclusively, or what was your approach at the time?
Yeah, so I've always managed my own fund, my own office. So I invest in deals directly myself. I'm not a passive investor. So
Okay,
I'm either buying companies, scaling them, getting out, or building and developing. I'm a merchant developer. That's been my business model. So I build, sell, buy, renovate, sell, build companies, sell. So that's kind of me. I'm a cash compounder, and then I'll store that wealth in other more liquid assets like treasuries, bonds, stocks, things like that. Knowing what I know now about Bitcoin and crypto, back then, 2008, 9, I would have just put it all in that, and let it ride and got out in November, December, and, just wait for the next cycle. But, I didn't learn about crypto until a couple of years ago.
Mm-hmm. Interesting. And so, but when you say your own deal, so is it meaning like being a general partner or actually your own private?
My own deals, yeah. Literally me, so in the
yeah.
world of syndication, so if people are in syndication or whatever, you hear the term control. Hey, we control 10,000 units, or, I own, or whatever. People use all these terms, with how they control or whatever. And what they might mean is they've either put a little bit of money in a syndication that's, 10 million, 20 million, $50 million deal. So they'll claim that they control $50 million worth of real estate because they invested $10,000 or $100,000 or whatever. They may not have even invested. They might have brought 4 or 5 people and then put their money in it. And then they say, we control. So no, I'm the owner, sponsor, my deal, my money. That's the way I've done most of my business. I'm signing the checks. I'm signing, the bank loans. Well, all my loans were non-recourse, but you still got to guarantee them. You still have to guarantee them even though they're non-recourse. But yeah, it's just me, my cash, doing my own deals, that kind of thing. And then I would do joint ventures with other investors and, things like that. My business model was always different because the investors that I've worked with over the years were a different level of liquidity. So the standard syndication model didn't fit what we were doing. It was more joint venture, partner, joint partnerships, that kind of thing.
Mm-hmm. Did you consider like investing in private companies where you yourself, through your knowledge, attempt to affect their valuation and their exit strategy and so forth?
Yeah, well, so that's what I did with other businesses. So, all of the businesses that I invested in were usually with somebody else. Sometimes I would put cash in them and the intellectual capital. Sometimes it was just intellectual capital, advisory and that type of thing. So yeah, that's how I did all the other businesses. So it wasn't like I just literally went and started all these companies. Some of them were startups, but they were always with other people.
Mm-hmm. Okay, understood. So that's kind of, and that's the essence of a private equity investor, where you join in yourself through your knowledge or capital and so forth, but you kind of try to affect, my understanding, I might be wrong, you try to affect valuation yourself. You want to have this control of understanding how you're raising the value of that company and so forth.
Yeah, that's me. Whenever I invest in something, I take control. So kind of like, you've seen the show The Prophet with Marcus Lemonis, when he comes in, he wants control.
Mm-hmm. Okay, so we have a question on the chat. So Scott is asking, so can you give a few examples of the types of deals that you're investing in, type of business, capital required, cash flow, exit strategy, etc.? Like just basically, if you can give us an example of perhaps a deal or type of deal that you're investing in.
Yeah, so I mean, one of the most recent ones was just land development. So that was something I was focusing on over the last couple of years, buying large tracts of land, splitting them up and selling lots to builders. Now that business model's changed because builders aren't building now, the market's changed, and I kind of saw that coming. But, over the last few years, those are the types of things that I've been focusing on, large land development projects, mixed use, where you got a little bit of commercial, you've got some residential lots, things like that. Working on some ground up multifamily deals around the country. So I, like I said, I coach and mentor people all over the place. So I'm working with a lot of people doing a lot of different things right now. Several ground up multifamily deals. I've got some doctors and dentists I'm working with that are doing strip development, doing like strip centers that you would normally see like a Starbucks, Chipotle, haircut, but they're putting a, dentist, orthodontist, pediatric dentistry, endodontist, all that kind of thing, and doing a dental strip and doing medical office complex strips. I had one of my clients I coached through a deal the other day. It was a 4 office portfolio deal that he found. It was 4 medical office buildings. So it was about a $9.6 million portfolio deal. And I helped him get that deal done without using any money down. And he ended up spinning out one of the properties and ended up with $100,000 a year in positive cash flow and about $1 million in equity right out of the gate without using any money, other than, minor closing costs, for recording title and all that. So, those are the types of things I'm working on and focused on right now with people all over the country, just kind of helping people learn how to do what I've done over the years.
Mm-hmm. And would you consider like value add multifamily, or perhaps kind of value add triple net, and maybe in like some of those deals? Or
yeah, so I've got some people, not me personally, I've got some people I'm working with doing the value add thing. And one of them I took from, I don't know, I think they had about 30 or 40, maybe 100 million in assets. Now they're at almost $1 billion. And it was 2 doctors, had no team, no employees really to speak of, and I've scaled them into they're in the Inc. 500 now. And they've scaled their team up to 20 people. And I mean, they're really getting after it, and they're buying, they've gone from doing 10 and $20 million deals to doing $100 million deals, and things like that. And it's all value add stuff. Some of it's core plus as they've grown, but some of them were bigger value adds along the way. But from my standpoint, what I love to do in that regard, I'm opportunistic. So I need a bigger lift than just your standard value add. So I like to go in and like totally reposition a property. Like, I like to buy old warehouses or things like that, or old buildings, and repurpose them into something else, maybe condos, maybe mixed use, things like that. You go into an urban core that's kind of revitalizing, and you buy some buildings up and, redevelop them. So, I mean, that's the kind of stuff I like to do.
Mm-hmm. Yeah, so opportunistic. And in terms of, so knowing the industry, and you're perhaps across like a few different industries, but knowing real estate so well, like through various businesses within it, and investing as well. So have you considered also investing in prop tech and like going more on the technology side? And have you done that?
No, I haven't done any prop tech yet. I was working with one company that was doing a real estate investor CRM company and property intelligence company, but I haven't personally invested in any of those. That's a good space. There's a lot going on. There's a crypto facing company out there called Proppy that's doing NFT, real estate NFTs. And, they're trying to, they're trying to streamline, the transaction process there with blockchain technology. So to me, that's interesting in terms of the whole NFT aspects of real estate, and then taking real estate on chain, to blockchain. So I think there's some exciting things coming in the real estate world with that. But as far as
you do like the tokenization, or perhaps not tokenization so much, but kind of improving the closing process through NFTs model that Propi has. Like, and so
I think what's interesting in me is just our system of recordation of title and process is just, everything's offline. And so, hard to get to, just the way blockchain can put it all out there, and transparent is kind of interesting. I don't know how the NFT solution would solve, not tokenization of real estate, but NFTs.
Right.
Where the property itself becomes an NFT, so you don't need to do the title transfer all the time. You're just selling an NFT. I think that's interesting, but I don't know how that can work with real estate, because real estate is so different and unique, and there's so many issues with title and boundaries and just all the things that you can have with real estate. But that's an interesting thing, an interesting problem that could be solved. That's a big problem that could be solved, somehow down the road.
So let's say, we are talking today kind of like a billion-dollar operator secrets, right? So if we take, you mentioned blockchain that's applied to real estate potentially, let's say, and also like you discussed before Bitcoin, that you would actually, you would have invested like more significantly in Bitcoin. So what is your what is your thinking in terms of like investing strategy? Like, what would you do now? Like, what is your argument on Bitcoin that makes you so bullish there, let's say? And you know, from the perspective of a person who has been so successful building up his network in kind of more secure, private company, controllable ways, let's say.
Yeah. So, you know, let's qualify that. I'm not saying I'm bullish now at these prices and, you know, and different levels. What I said was back then, because you started basically from zero or a few cents and it went up to 60 grand. So, I mean, that's just unheard of. Although real estate's done that, you know, in certain areas. So you've had returns, but not in the same amount of time, you know, necessarily. But that's why, because it's just such an exponential technology. And so what's interesting about Bitcoin in and of itself is you know, from the standpoint of it's a speculative asset, it's a risk asset. So I'm not a Bitcoin maximalist, right? I understand the technology, blockchain, all that. You know, it's a you know, trustless system, you know, truly decentralized, you know, things like that. But what's interesting about the Bitcoin play itself is that the network effect. So it's an emerging technology. It's only been around 10 years, and it has you know, blown up exponentially in a quick time frame. And you have more institutional players interested in Bitcoin. Some Ethereum, when that switches to proof of stake, that might change. But right now, you know, Bitcoin is on the radar of a lot of institutional outfits. And, you know, BlackRock came out the other day. They're doing a deal with Coinbase so they can bring in their institutional clients into, it's either BlackRock or Blackstone. I get them confused all the time. To bring their institutional clients in so they can get exposure to Bitcoin. So you've got more institutional people coming in. And, you know, Bitcoin is one of the more secure, safer networks. Obviously, it's instantly transferable, you know, trustless, you know, open network, you know, all the different things about Bitcoin. And in terms of being bullish on it, once the price bottoms out, just like the market. So I'm in the markets too, especially with the volatility that we've had here lately, big moves. You know, we had a 30, 40%, you know, swing in some of the stocks here lately. But once everything settles, once inflation plateaus, the Fed is finished their interest rate hike, we get, you know, QT resolving, and we can get back to a stable understanding of how mild or deep is this recession going to be and last. The markets can then find a bottom and start reversing. And when that happens, you're going to have huge opportunities in markets. Generally, Bitcoin is, you know, 10x exponentially to the upside and to the downside of the markets, as we've seen. You know, Bitcoin's down, I don't know, 56, 65% right now or something, and markets are down 20 or 30. So, you know, it's 2 times as much right now, but it'll go, you know, 10x to the upside. And if you look at the bottom of 2020, you know, Bitcoin, you know, 15x, you know, where the markets, you know, didn't quite go that far. But that's what I like about it. And I think that, you know, given a normal environment, getting back to, you know, more normal global macroeconomic cycles, risks of war off the table in general, and, you know, we can get back to supply chain issues being resolved, I think you can see Bitcoin get back to, you know, 100 grand, you know, pretty quickly, you know, going into a 6 month to a 1 year time frame. You know, I'm not one that thinks it's going to hit, you know, 500,000 or a million or 10 million or anything like that, you know, anytime soon, if in my lifetime. But I do see it getting back to 100,000 at some point once things kind of level off.
Mm-hmm. And you did mention you kind of, you focus on this kind of macro understanding of the economy and that. So what is your outlook on real estate now? And
you know, real estate's in transition and it's all interest rate related. So going back to 2008-9, I had $30-40 million worth of real estate, you know, in different processes back then. And, you know, I understood very intuitively back then, it's all about interest rates. So it's liquidity and it's interest rates. That's the 2 things that drive real estate. You got to have money to fund it. And then that cost of that capital affects the values. So right now, interest rates are going up, you know, especially residential rates. They just went over 6% again. So we're seeing a correction in the housing market. We're seeing cap rates adjust nationwide in the commercial and multifamily world because, again, it's cost of capital. And, you know, you can only pay so much for an asset. It's got to be able to return. So we're starting to see some adjustments. You know, how deep and how far that goes depends on how high the rates go, and it depends on the availability of the debt. And, you know, when the Fed starts unloading, you know, mortgage-backed securities from the balance sheet, that's going to put a lot of pressure on the debt and credit markets out there. So, you know, the financing might be a little bit more expensive and a little bit more difficult. We're already seeing that. You know, the agencies are, you know, strengthening and stiffening their requirements a little bit, and, you know, scrutinizing deals and markets a little bit more. And those types of things, kind of like we saw in the pandemic. So right now, we just don't know how far, how deep this is going to go. It just all depends on how high the rates go, how much the Fed has to do, and how quickly we can recover from the damage that they have to do to get things back under control because of everything that's been done since 2008-9. And that's really what we're doing. We're unwinding what's been done since 2008-9. What, $4 or $5 trillion pumped into the economy,
Right.
zero interest rates forever, and the biggest asset bubble that we've ever seen in all assets all across the world. It's really amazing times, and it's hard to believe we didn't get any inflation before the pandemic.
Yeah, it's like a very quantitative easing period for a pretty long time, and so it's interesting. So I'm not sure, like I'm not knowledgeable if it's like indeed the biggest one or not, but it's pretty distributed across assets, and perhaps to a lesser extent in real estate than some others, but still. And so so what's your view in a recession, like considering that? So considering what you mentioned, there's some unwinding of kind of the massive central bank easing policy that they've had for already 12 years and more than that, and pretty much past the global financial crisis. And so what's your view in terms of actually declines that could happen? Everyone has different views. Do you expect past a recession to see some declines in real estate, and if so, where, in which markets?
So declines in what?
In real estate values, and do you expect
values? Yeah, I mean, real estate's it's hyper local. So you really can't give a real spectrum of that. Every market's different, every asset's different, every type's different. So it's really gonna vary greatly. And you can look at national averages, and house prices aren't really coming down all that much. They're actually still going up, from a national average standpoint. But certain markets, prices are down, and that's the thing. So prices are down in certain markets, but down from what? Really crazy prices they were listing at. So let's talk about the commercial market, because that's a little easier, right? Because cap rates kind of work from geographic standpoints, and typically where you saw multifamily, for instance, in 3, 2.5, 3, 4 cap, you'll probably see that increase to 3, 3.5, 4, 5 cap, right? So it just depends on the city and the asset and things like that. We're already seeing office cap rates, get back close to 10% in some areas for some assets in some markets, because, office is struggling. Retail's struggling. So those assets are going to, have really good cap rates. You're going to see those values get cut by 30, 40, 50%, that kind of thing. We're seeing housing markets in some areas, Arizona, Austin, Texas, some places like that, housing values are getting cut by 20 or 30%. But again, what number did that come from? It was an astronomically high number that never should have been there to begin with. So it's kind of coming back to almost normal, right? So it really depends and what really happens, and how high these rates go and for how long.
Okay, so let's open for questions. I don't want to go too long where we're also still recovering, right?
I'm hanging in there pretty good. I'm kind of surprised.
Doing good, actually. That's true. So do you guys let's open up the floor for more questions. So do you guys want to, speak up, ask a couple of questions, or if you want to put them on the chat, they will relate as well. Yeah, Scott, go ahead.
Hey, great presentation, Greg. Thanks for being here. So I guess, I know no one has a crystal ball, but my question is just from someone like you who's been doing this for so long, and now kind of forecasting like the rest of us that there's still some frothy times to come. At this point, I know that like a lot of really sophisticated investors say that money is made in recessions. So this could be really fertile times for a lot of millionaires to be made, and a lot of really lucrative projects and investments to kind of begin. So what is your perspective on that? Are you going in pretty heavy right now and over the course of the next 6 to 12 months in any specific asset class? Do you have any, what is your standpoint on exactly how you're dealing with the times that we're living in and the fact that opportunities are starting to present themselves?
Yeah, so I'm opportunistic. So I look for deep, big opportunities. So I like to be in at the bottoms. First time I invested in the markets ever, stock market, was bottom of 2009. Never did it before till then. And I knew that was the time to go in, because that was economic Armageddon. Everybody thought, the stock market was going to just go to zero. So I look for those types of opportunities, just where I'm at in the stage that I'm in now. I've been playing, with the bear market since the, November, December. And, I called the top back then in, pretty much everything. And I've been kind of playing the bounces along the way. So once I feel like we've reached bottom, and I don't think we've reached bottom yet in the markets, I could be wrong, but I don't feel like we have. That's when I'll make some bigger moves in the markets and things like that. As far as real estate goes, I don't really look necessarily at the cycles, although I do pay attention to the global macro picture, but I look more at the asset and the opportunity itself. So it's always a good time to buy. The problem with a bull market is, you think you're a genius in a bull market when you're just lucky it's a bull market. So pre 2008-9, everything I touched turned to gold, and I didn't think it would ever change. It just, everything went up, everything worked. I had no clue that could ever change. And then 2008-9 was a big, awakening. The last couple of years, a lot of people that never went through anything like that, everything was easy. Everything was just going up. Didn't matter what you bought, everything went up. That's what I mean by the biggest asset bubble in all classes: real estate, stocks, crypto, everything was going up. Companies, equity, capital, multiples. You could buy any company at any multiple, and then you could sell it to another equity shop for more money. So we're in a different environment now. So you got to be real careful, and you got to look deal by deal. But there's deals out there. So depending on what your business model is, if you're opportunistic like me, you need to understand where the market is, where it could potentially go, and it's risk reward, right? So if I'm going to buy this building and renovate it, and I think I can get, $100 million for it. Well, if it traded at a 3 cap and which would make it 100 million, last year, probably not going to trade at a 3 cap for 100 million this year. Probably going to trade at a 5 cap. That's how I look at it. So I need to buy so I can trade at a 5 cap this year. Now, if you're buying income producing property and your thesis is long term and you're not going to sell, then you pay whatever you want. It doesn't matter what you pay, as long as you can service the debt and hit the cash on cash you're looking for, or return the investment target that you have with your investors if you're raising money from investors. So that's why deals are continuing to get done, because debt is still cheap in my terms. I mean, I was paying 9% interest on all my construction loans back in the day when I was doing a lot more development. So even at 5 or 6%, that's still cheap. So you just got to make sure that you're paying an appropriate amount so that you can service that debt and return on capital that you're targeting. So, and as far as the company goes, you need to understand the shift that's going on, in the consumer, how people are consuming, where they're buying, what the opportunities are, how technology is changing business. And if you're looking at those opportunities, you want to make sure you've got something that's going to, be around for enough time to be able to exit that thing or do whatever it is you're going to do. And, with the employee situation that we're in right now, you have to, understand what those costs are and what the opportunity costs are going to be of your time and capital, trying to deal with those situations in this environment. So, good times never last, bad times never last. And there's opportunities in both. In a bull market, you lead the market up, you buy here, you're going to sell here. When it shifts, you lead the market down. It used to sell here, now it's going to sell here. So you got to buy down here, right? So you want to kind of stay ahead of the cycles.
Right. Yeah, that's lead the market down, right? That's a great point. And actually, I just want to add to what you mentioned, Greg, because with regards to like picking up a bottom after the peak, I just want to note, like, for most people, and that's just price histories, it typically took 4 or 5 years. That's not just the global financial crisis. It actually took 4 or 5 years for extremely mild price declines after prior recessions, such as 1990, and still a 5-year period to actually hit the real bottom. So it's, even if you have a 10% decline, it's quite interesting. And so that's
it is.
It's actually a pretty lengthy process in real estate. It's not something I feel like a lot of people are feeling, it's like it's going to be like this year or next year or something. It's typically not the case.
Yeah, real estate's different. And, the real estate syndication popularity over the last couple of years has kind of changed the game in real estate, because it's so easy to raise capital and it's so easy to do big deals now. So that's really changed the game there. The housing market's different, and that's a different animal. It's going to take a long time for the housing market to correct, because this is nothing like 2008-9 for anything.
Yes.
We don't have a lending problem like we did back then. We don't have bad loans like we did. Commercial's probably got more bad loans, especially multifamily, because there's been a lot of interest-only bridge debt that has been originated in the last 2 or 3 years, where syndicators have come in, they've paid too much for the properties, they've got interest-only bridge debt that's coming due in the next, couple, 2, 3 years. So we might see some deals blowing up there. but the banks know how to handle that now. And there's operators out there that'll take those assets over. So you're not going to see the damage in there like it was before. In the housing market, the loans are healthy. I think 70 or 80% of the loans are under 4%. They're qualified borrowers. They have high credit scores. They put big down payments. And, so the housing crash boroughs out there, they're just not looking at the reality of the health of the housing market. There's no inventory. And sellers right now aren't going to sell when they're looking at 6% interest rates and no good options to buy where they're going. And they all can't rent. They're not all going to rent. So the housing market could take years just to get back to normal levels of inventory, much less, serious enough decline, so that's a really interesting thing that we're experiencing in the housing market right now. But commercial is a whole different animal.
Correct. But do you think commercial, like considering like the super high rent growth from essentially people not being able to afford purchasing and kind of like inflation having a very dislocatory effect of sort into like humongous rent growth? So do you feel like that may lead to perhaps bigger overvaluation in commercial real estate compared to or commercial multifamily compared to the general housing market? Because I feel like commercial investors, they tend to think commercial is safer and it has smaller declines because they're basing it off the global financial crisis. But that's just because global financial crisis, single family was inflated. But I feel it could go the other way.
Yeah, so multifamily is your safest, type of commercial real estate to invest in. It always has been. It's recession proof. People need a roof over their head. Rental housing is in the highest demand right now that it's been in a long time. Pressures on housing is putting that, in demand. And we've seen record increase in rents, but we're also seeing pushback, in some areas. People are moving because they can't afford it. So the problem with that is, or the thing you got to weigh there from risk reward standpoint, is you need to understand the income levels of your tenants, and you can only push that so far. What we've seen is it can be pushed a lot further than we thought, but normally it's about 30% of income. Now you're seeing people paying up to 40% of income, and even more in some areas like the cities. People will pay 50% of their income to live in the city because they don't have to have cars and all these other things. But, other areas that are suburban, you start pushing that threshold, people are going to move. They just can't afford it and they're not going to be able to pay it. And we're seeing that happen. Now, the biggest risk to the rental market out there for investors is rent controls. A lot of cities and states are talking about rent controls and, doing things to try to help people, because it is getting pretty bad for a lot of people with their rents doubling and, and more in some areas. So, again, it's going to be market specific, it's going to be asset specific, but right now there's still a big demand for rental, especially single family rents. I'm working with a lot of people doing build to rent communities, from ground up development, and as well as Airbnb. But, it's in big demand right now because, people just don't want to pay for housing right now. And especially with interest rates where they are, the affordability of that payment's been cut in half.
Okay, so that's Jimmy, I think you have a question.
I do.
Is right after the Airbnb build to rent discussion.
I know, right? He goes right into what I was going to ask about. But Greg, I had one more general question around capital raising, and I wanted you to put yourself in the shoes of somebody. So imagine starting from scratch. You have no network. You're in a foreign land. They speak English though, so we'll make it easy. What are the steps that you would actually do in terms of trying to get back to the level of success that you've had over the years you've been in the real estate, if you had to start all over again?
Yeah. So number one, educate yourself. You have to be an expert in whatever it is you're raising capital for. So you need to know that business, know the, markets that you're in, things like that. That's number one. Number two, it is about your network. Your network is your net worth. But let's say you don't even have that ability. Now you have social media, where if you do accredited investors only, you can advertise, you can do general solicitation. So first and foremost, yourself. Second, the deal. You got to have a good deal. It has to be worthy of investment capital. And then three, leverage technology and social media and advertise that deal. You can advertise it on Facebook, YouTube, Twitter. And that's the game changer for a lot of people I work with, is showing them how to put their deal out there to investors and raise that capital. So, it's really a lot easier than it ever was before, where I used to have to go and literally face to face and meet people and do that kind of thing.
Yeah, let's take it a level deeper. So for social media, is there particular channels that work better than others, or is there a specific messaging that tends to work well?
Yeah, so Facebook is obviously still number one for that kind of thing. Twitter is pretty good too. If you pay attention to Twitter, you'll see one company in specifically that's advertising commercial grocery anchored centers to invest in. But basically, it's it's just putting the deal out there, and you'll see them when you start looking at what I'm talking about. And you can target. You can say, hey, accredited investors, and just talk about what the deal is or what the opportunity is that you have for them to invest in, whether it's a business or or a piece of real estate. But the key is, just to put it out there. There's no real targeted messaging. The couple of things you want to stay away from is, don't try to offer or say that, you're going to hit these obscene above average returns, hey, 30% IRR, 40% IRR. People know, so, I mean, 18 to 24% IRR, that's a great target, 12 to 14% IRR, that's going to get people's attention, that kind of thing. Well located, good quality opportunity, to grow, the income, to grow the value of the asset, 3 to 5 year exit, just little bullet points. That's it. And, but the key is, again, is just, you got to make sure that you know what you're doing, you understand the asset, you understand the business model, and, you're somebody that people can trust, at the end of the day, because you're gonna have to talk to them at some point, and the best way to do it is put that thing out there at scale and then schedule investor webinars like we're doing here, get everybody together, talk about the deal, answer questions, be honest, trustworthy, and, know what you're doing. And you can hit the ground running and start doing big deals right now. There's people out there that will come alongside you and guarantee the loan. So if you don't have a net worth, so that's the other hindrance. It's not just raising the capital, but you got to have a net worth equal to the loan. And then you got to have liquidity, of a year's worth of the payments, or sometimes they're going to want to see 10 to 20%, of the loan in liquidity. But you can find those people that will come alongside you and provide those and fill those holes in for you. So again, that's just putting it out there and letting people know. The other one is Facebook groups. So those are powerful. There's a lot of Facebook groups where people are looking to invest and are looking to come alongside people and act as a KP or a general partner to help them get a deal over the finish line.
Nice. Thank you for sharing, Greg.
Great. These are great suggestions. And actually, just since you mentioned build to rent, and we spoke about Bitcoin before, I've heard like some people refer to build to rent as kind of Bitcoin segment of the real estate market now. Is that kind of like a very hot segment and essentially a superior product to the rest of the market? Is that a position you share yourself, or perhaps not as far as Bitcoin, but still do you view it as a segment that has like larger potential than multifamily and other more typical traditional sectors?
So say that again.
Yeah, I mean, I've heard this build to rent referred to as the
build to rent.
Bitcoin,
Okay.
the Bitcoin segment of real estate, kind of. So,
Yeah.
Yeah. Okay. So is that something that, like, what is your take on that?
So when you say that, you mean network effect, right? So real estate syndication is the Bitcoin of the, so it's all about network effect. There's nothing that's going to reach the exponential upside that Bitcoin saw. I mean, that's just phenomenal, right? 10 years going from 0 to 69,000. I mean, yeah, obviously, like I said, there's real estate examples that you can see, but it's over 50 years, not over 10. But in terms of network effect, where everybody's excited about it, everybody's on, it's Airbnb, a lot of people doing short-term rentals, build to rent is, I mean, it's inefficient, so it doesn't have the exponential ability that like a cryptocurrency has or anything like that. Real estate syndication is probably the most exponentially relatable one to a Bitcoin, because in real estate syndication, you can do $100 million deal, with nothing. Like, like we talked about a second ago, you don't need any money. You just need a deal, and you put it out there and you bring all the pieces together, and you can raise, a couple $100 million and do $100 million deal. You can do that. Yeah. You just got to know what you're doing. You need to understand what that looks like. And believe it or not, it's easier to get those bigger deals done than it is little deals. But yeah, that's interesting to me. And I remember the first time I ever heard about syndication, I was working with this couple, and she was the husband was a doctor, a physician, and I guess she ran the practice with him, worked in the office or whatever. But anyways, they were investing money and doing things, and we were doing some deals together. And then one day they told me, they said, yeah, we're investing in this, really huge office complex, $100 million office complex. We're going to be partners. I'm like, how are you doing that? It's the first time I ever heard of syndication. So people like to talk about it like it's like it's a, you know, a social thing, you know, it's like an icon,
You see. Mhm.
you know, being part of those big deals like that.
Yeah, yeah.
It
Bigger
almost
deals-
is.
Yeah.
I'm sorry to interrupt. It almost
Yeah.
is. When I'm speaking with people about syndications,
Mhm.
I get responses like, it's a Ponzi scheme. Why isn't everybody doing it? I'm like, everybody are doing it. I can
They are.
I can introduce you to like 100 people that are doing it, because it's just not typical, and they don't understand the returns. And even my friends who are in single family space, and I told them about bonus depreciation, they're like, no, well, what does that even mean? And then I explained, and their jaw just dropped. They didn't get it. So it's a big process. Even when it comes to Airbnb, it's not as scalable as multifamily.
Or commercial, you know, all types of
Yeah.
commercial, but you know, multifamily is the safest. That's why it gets the most attention, and that's why the cap rates are so compressed.
Mhm. Great. So, Greg, what is the best way for people to reach to you? I think we had like some amazing discussion here today and questions, and really appreciate taking the time.
Yeah, absolutely. I appreciate you having me. And before I go, I'll just, you know, leave
Yeah.
one thing with everybody. Like I said in the beginning, you know, you have no limitations. If you fully embrace that and receive that, you have no limitations. You can do these big deals. You can do whatever you want. You got to educate yourself. You got to learn the process. You got to understand the markets, but there's no limitations. So don't limit yourself. We're in the biggest, best opportunity we've ever been in the history of the economic history of this country. And it's going to come back around. This little bottom that we're in right now, even if we go down further, whatever, it's going to turn back around. And when that bull cycle comes back on, it's going to be just like it was the last 2 or 3 years. It's going to be phenomenal. So don't limit yourself. Don't think you can't do it just because it's got 4 or 5 zeros behind it and you've never done it. There's no difference between doing $100,000 house and doing $100 million building, other than obviously the size of the property. But it's, you know, if it's a multifamily or rental property, it's income and expenses. If it's $100 million building, it's still rent coming in and expenses going out to operate it. If it's a $1,200 a month house, it's income coming in and expenses to operate it. Taxes, insurance, maintenance, same thing. There's no difference. So just, you know, take that with you, and whatever it is you've been thinking, man, I'd really love to go do this. I just don't know how. I just told you how. Educate yourself, put your deal out there in front of people, and just don't let anything stop you. Just remember, there are no limitations. Just go do whatever it is you want to do. So that's, I'll leave you with that. And, you know, my website's gregdickerson.com. You can find my YouTube channel link there. I've got a ton of content on my YouTube channel and all that. And that's what I'll leave you with.
Awesome. Thank you so much. Appreciate it.
Yeah. Good to see y'all.
Thanks everyone.
Thank you.
For joining.
Yeah. Bye-bye.
Thanks, Greg. Steph.
All right, Jimmy, take care.